Hey, this podcast holds nothing sacred. This is Life, Tech, and Sundry. And what is Sundry? It's our experiences put in a melting pot to the internet. So join us on this wild ride called the LTS Podcast. Follow us at LT Sundry on Twitter, LTS.pod on Instagram, Life, Tech, and Sundry on YouTube, and all your favorite podcast distribution services. Stay frosty.
The Phantom Tax: How Inflation Erodes Reality. Picture this. You work your job all week, your paycheck drops into your bank account on a Friday, hopefully, no judgment, and the number looks totally normal. Nothing was stolen. Your account wasn't hacked. But when you go to buy groceries, fill up your gas tank, or pay your rent, you realize that the exact same amount of money buys noticeably less items than it did just a year ago. In our first episode, we looked at how trade started, this simple barter, swapping apples for milk, dealing with the headache of finding someone who wanted what you had to sell or to trade. In part 2, we explored haggling, the street market art of bargaining face to face to land on a fair price. But today, in part 3, we're looking at inflation. Unlike a seller at a flea market, inflation doesn't negotiate. It quietly chips away at the real buying power of your money. In the background. Salutations, I'm your host, Marcos Lopez, and you've tuned into LTS Out of Office, the show where we break down the global economy before your morning coffee gets priced like a luxury item. So grab your drink, get comfortable, and let's get into how this hidden tax works. The basics: printing money, supply, and demand. When the world moved away from trading physical items or gold coins and switched to paper cash, everyday buying got a lot easier. But it also meant governments gained the power to create more money out of thin air. This is what I like to call the paper money switch. Barter was limited by whatever goods you carried, and haggling depended on what was available locally. Paper cash fixed that by creating a shared system of trust. But if you print way more cash without actually making more goods and services, each individual dollar simply loses value. This is what I like to call the basic rule of supply and demand. I think it's actually in the economics. Anyways, think of it like trading cards. If a rare card gets reprinted by the millions, its value drops immediately. The same thing happens with money. When too much cash chases too few products, sellers raise prices because buyers are willing to pay more. Supply and demand, people. Supply and demand. Too much spending, basically. When banks lower interest rates and make loans super cheap, people and businesses borrow and spend freely. When everyone rushes out to buy cars, houses, and electronics at once, demand shoots past supply, pulling prices up. A cost push or expensive production. On the other side, big distributions like oil shortages, bad weather ruining crops, or factory delays make raw materials more expensive. When it costs more to ship parts across the ocean or fuel delivery trucks, businesses pass those extra expenses straight to the customer. How to measure it? It's something called a CPI. Economists track this using a consumer price index, or CPI. They track a giant, hypothetical by the way, shopping cart of everyday items like bread, rent, gas, and clothes to see how much the total bill goes up each year. Now, there's a catch to this, a big one. Official reports often look at core inflation, which ignores food and energy, because their prices bounce around so much. But for a regular person, groceries and gas are the most important parts of the monthly budget. Now, to be fair, a tiny bit of steady inflation around 2% a year is actually healthy. It gives people a reason to spend and invest their money today instead of sitting on piles of cash, which keeps the economy moving. You incentivize them to spend that cash and make them with goods and services that attract them aside from their living expenses in order to keep the market moving. You incentivize, you give them a good circus, bread and circus, if you will. So, we know how central banks and supply chains affect overall price levels. Next, let's look at the clever tricks companies use at the store to make you pay more without changing the price tag. The grocery store tricks, shrinkflation, and sneaky cuts. When making products gets more expensive, brands run into a problem. If they bump a $4 snack up to $6, shoppers might leave it on the shelf. So instead of raising the price tag, they change what's inside the box, something called shrinkflation, and now I'm going to explain it. Shrinkflation is when the price stays the same, but the product gets smaller. The bag of chips has fewer chips and more air. The soda bottle drops from 20 ounces down to 16 ounces. Or the candy bar loses a couple of bites. For me, I noticed this in the Oreo strips or those Oreo 6-packs. Back in the day, it used to be an 8-pack. You pay the exact same amount at checkout, but you take home less food. And with shrinkflation, there's something that is also connected to theoretically as cheaper quality. If a company can't shrink the package anymore, well, they might swap out quality ingredients for cheaper ones, like replacing real butter with cheaper oils. Or a company might cut their customer service phone line and make you talk to an unhelpful automated bot instead. Now, there's also another part, taking advantage of the news. When the news is filled with stories about inflation, customers already expect everything to get expensive. Some major corporations use that as an excuse. The news gives them a reason, if you will, to hike prices even higher than their actual costs. Basically, even though their costs to make business stay the same, they just hike the prices up, boosting their profit along the way, while you and I spend more. Now, why do our brains miss it? Most shoppers glance at big dollar price, not the tiny fine print showing the price per ounce. Companies know human psychology, so they change the package size instead of the price, or any of the tags basically, to keep us buying. The other side of the story, not every company is trying to trick you. Small and medium businesses often run on thin margins when their electric bills, box packaging, and shipping costs double. Shrinking the package might be their only choice to stay in business and keep staff employed. Now, to be fair, modern manufacturing is complicated. Adjusting package sizes and product design lets stores keep shelves stocked during supply crisis instead of running completely out of goods. Now, we've covered broad monetary policy and sneaky packaging tricks on store shelves. Now, what happens when high prices stick around for years, and who actually wins and who loses? The fallout, the paycheck trap, debt, and wealth gap. Inflation doesn't hit everyone equally. It acts like an unvoted wealth shift, hurting people who rely on steady hourly paychecks or cash savings while helping people who own lots of physical assets or fixed rate debt. When everyday living gets spicy, workers naturally ask for raises just to keep up. But To pay higher wages, businesses, guess what? Raise the price of their products. That makes living costs go up again, causing workers to need another raise, creating a spinning cycle that's tough to stop. This also triggers inflation, triggers something called the panic buying mindset. When everyone starts believing prices will be higher next month, people stop saving and rush to buy cars, appliances, and tools right away. This rush of spending speeds up the exact price hikes they are worried about, and thus, who wins? Asset owners. People who own physical things like houses, land, or company stocks usually see those asset values go up alongside inflation. If your home value rises, your net worth grows. But if you're renting and working on an hourly wage, you just feel the pinch of rising bills. Now, there's something called the borrower's secret advantage. Anyone with huge fixed rate loans, including the government, actually benefits from inflation. If you borrow money today and pay it back over 30 years with cheaper, less valuable dollars, your real debt burden gets smaller over time. Now, there's something called extreme hyperinflation. When trust in money completely falls apart, like in Germany after World War I, or like Venezuela in the recent years, prices double every few days. When cash becomes worthless, people abandon paper money entirely and go right back to bartering goods and haggling in street markets. This causes a real world stress. Beyond the math, inflation adds constant mental pressure to everyday life. It turns simple grocery trips into stressful calculations and makes planning for the future feel exhausting. Now, to be fair, central banks have real tools to fix this by raising interest rates and cooling down borrowing. They can tap the brakes on the economy and bring price increases back to normal, even if the slowdown feels rough for a bit. That brings our economic mini series to a full circle. We started with barter, trading basic goods through mutual need. We moved to haggling, learning how buyers and sellers agree on a value in real time. And today, we talked inflation, the broad economic tide that changes the value of money without asking for our permission. If this breakdown helped you make sense of what's happening to your wallet, hit the follow button or subscribe and share this episode or any of the episodes with someone who's tired of getting less for their money. Putting these research episodes together for LTS Out of Office takes plenty of coffee to keep everything running. So, if you'd like to support the show, check out the Buy Me a Coffee link in the show notes. Until next time, stay sharp, watch your cents before they make no sense, and don't let the phantom tax float away with your purchasing power. See you on the next installment of LTS. Stay frosty.